Let's welcome him. Hi, Martijn.
Thank you.
Thank you for being with us today.
Thank you for having me, and it's a pleasure to meet you.
I'm glad to be having this conversation with you today.
Okay.
Have a seat, please. Private debt financing, often considered as complementary to private equity, has grown significantly in Africa lately. Fund managers have played a pivotal role in bridging the financial gap for mid-sized businesses, often, who face challenges to access traditional banking facility. This expansion is crucial for the economic development across the continent. In your opinion, what is the current state of private debt financing in Africa?
Well, before I answer that question, let me start with a bit of a global picture in terms of what we're seeing in the private credit markets globally. It's an asset class that has grown about tenfold over the last decade, which is currently about a $1 trillion asset class. What we have seen is that allocations to emerging markets, including Africa, is about 3%. This is relatively a small portion. We expect that to grow, but the market is still nascent. We, as 91, are quite active in this market through a number of private credit funds that we have, focusing on multi-assets, financials, corporates, telecom, as well as infrastructure companies. We believe this has an important role to play on the continent, as you say, as an alternative channel to typical banking channels. So it's a nascent asset class, but we believe it has every opportunity to grow very fast. And it proves that we just closed our third Africa Credit Opportunities Fund at $260 million as a first close.
Congratulations on that.
Thank you very much.
We take note that there's rising interest rate following the pandemic. The cost of borrowing has increased. Public debt has increased globally. How are all these factors, all those global economic environment factors impacting private debt in Africa?
So obviously with the rising interest rate environment, it had a change in asset allocation. So in developed markets, when the risk-free rate is high, so we have a shift actually seen a little bit from emerging markets back to developed markets. We believe that emerging markets, including Africa, is still attractive to invest in for a number of reasons. One, you work with a lot of companies that have significantly lower leverage than you would see in developed markets, where we have businesses that we finance are 2 to 3 times levered. In developed markets, that's about 5 to 6 times. We back regional champions that are very resilient to kind of interest rate rises, currency, and also can weather economic and political challenges on the continent. So it's a very robust asset class, despite the things that you are managing, also proven by the low loss rates and default rates that we're witnessing in our portfolio. So we believe that emerging market, including Africa private credit, provides a premium over what you would have in private credit in developed markets, with very conservatively financed companies and with extremely low default rates and loss rates.
Yeah, I think you mentioned it, the default risk is there in Africa. So private debt financing in Africa comes with its own risk that often reflect the current political, economical and financial landscape of the continent. Those risks can affect investors and fund managers who are seeking to deploy capital in that asset class. As a fund manager, how do you manage default risk and also currency risk, which is a big risk for fund managers to consider?
Let me take the last question first on currency risks. So we provide debt financing typically in hard currency, dollars or euros, or we can provide local currency financing where we find appropriate hedging. So typically we back companies that either have dollar denominated income or dollar linked income. If that were not to be the case, obviously we would stress test whether companies would be resilient to currency shocks. So that's typically what we do. Yeah. Alternatives would be to work actually with local currency financiers in the market to do a mix of hard and local currency to make sure that the company is resilient and able to take on these currency risks. In terms of economic and political environment, that's what we do. We as 91 come from the continent. We're an originally African continent, and we are specialized in being able to navigate that environment, and we will look at backing businesses that are able to do so as well.
And how, I need to ask this, how easy or difficult it is to assess the creditworthiness of your borrowers?
Well, we would do that like any other financial institution would do. We would look at indeed what kind of market do they operate, how strong is the shareholder base, how strong is management, how resilient is the business case to potential market, economic, political shocks, and what is the long-term future of this business in the markets that it plays. That's a couple of factors that we would typically look at.
So although there is the big issue of default risk, there are means to be able to manage that and assess your borrower's creditworthiness.
Yeah.
Then. All right. And despite the risk and the challenges that Africa is facing, we need to acknowledge Africa currently presents a range of compelling opportunities for fund managers. Those opportunities are often driven by economic growth, a growing population, and infrastructure need. Based on your experience, what are the current opportunities in Africa right now?
Yeah, I would say the biggest opportunity in Africa in private credit is that it's still an uncrowded market, right? So you are able to pick up very good opportunities with well-run companies, lowly geared, with excellent management, and having pretty dominant market positions in the markets that they operate. The great opportunities, my particular focus within 91 is focusing on infrastructure. So we have financed a lot of public-private partnerships on the continent, being it power, renewable energy, toll roads, public transport. We have done a lot in the power and energy sectors, financing a lot of renewable energy. We expect this trend to continue. There's a big need to transition the energy mix on the continent, and renewable energy provides low-cost power. So great opportunity, we'll continue to do that. More recently, we also have focused a lot on digital infrastructure. Telecom towers, data centers, fiber. Connectivity is essential. Internet services are being brought closer to the markets where they operate. So great opportunity to continue investing in those markets. And then thirdly, I would say in the transport sector, there's still a lot to be done on the continent to improve that, which creates opportunity to improve connectivity. So indeed, the likes of toll roads, public transport, rail, and we do believe that despite the budgetary constraints of governments, then when they would focus on setting up programs with the private sector and would set up PPPs, it is a great opportunity to still build that infrastructure that is essential for economies to grow.
Interesting. Now, I mentioned it earlier, private debt was often considered as complementary to private equity. However, we have seen that private debt itself is a market which is expanding on its own. What is causing this shift from people traditionally going into private equity, and now people are moving to private debt? And what is causing this shift in the appetite of fund managers and investors?
So I think what private credit can provide is stable income, right? With a significant premium over what you would typically get on private credit in developed markets. And obviously depends a little bit where you want to play in the capital stack and in which debt space. So what we provide is all the way up from senior secured, which is predominantly what we do, all the way up to mezzanine. And then it could be, if you want to play in the mezzanine space, it's an excellent way of picking up higher yielding returns but still have a debt-like product, which has a slightly different risk profile than playing in providing equity to companies. And typically you would have lower volatility than providing equity, and I think that's an attractive role that private credit can play.
Yeah, I think that is very important when it comes to Africa. The return that private credit secures is different to that of private equity, and maybe this is causing the change in the shift from private equity to private debt right now.
Although I think these products are also very complementary. So we will actually work a lot with private equity providers by supporting them in project itself and just taking a position just above the equity in the capital stack, or even back leveraging some of the equity providers, providing leverage to equity funds so that they can accelerate their investments on the continent.
Martijn, it's been a pleasure to have this conversation with you. Any closing remarks for us?
So we are very excited about the future of the African continent. Will create a lot of opportunities. Its economies will grow, a young population, big focus on, we see a lot of urbanization going on, which will create demand for products that people need. And we feel that long term Africa is a very good destination to invest. And we always say at the end, come and join us on that journey.
Yes, and we are happy to accompany you on that journey also. We are also an African company, and we believe in the growth of the continent as well. Thank you very much for this, Martijn.
You're welcome.
I hope this session has been insightful to you. Stay tuned for the next episode of In Conversation with ITL.